Hello, everyone. We'll be kicking off shortly. Just give me a few more minutes. We've got about 2.5 more minutes before we go live. Thank you, Rachel, for helping me with any Q&As that'll come through Facebook. Can you do me a favor and post those into the Q&A when they come? And also, can you confirm my audio is coming through? Great. I assume, actually, I know my audio is coming through because you just answered my question. Thank you very much. I appreciate that. So we do have about 2 more minutes. If anyone has any questions, any of the early birds who've joined us early, if you've got any questions, feel free to post those into the chats or just say hi. It's always great to connect with new people. Elena and Paul, I don't think we've met before, so it's nice to meet you guys. Yeah, I'm going to start queuing everything up now, so bear with me a second as we are going to take this live onto Facebook. Almost there, I swear. 1 more minute to go. Okay, and go live. Okay, I'm going to assume everything's going live well on Facebook. If not, my colleague Jose is going to give me a heads up. So thank you, everyone, for your patience and joining us today. Today's session is going to be on the top tax tips for real estate corporations. I'm really excited about this new opportunity that effectively happened in October that's going to allow realtors to take advantage of personal real estate corporations. These are tax advantages that we have been helping our clients with for decades. Now, before we do get started, I want to go through just a small amount of housekeeping with you. So we're on Zoom today, and we're also live on Facebook. For those of you that are live on Facebook with us, you can post your questions into the thread itself, and we'll be making sure to have a colleague reposting those here into our Q&A. For those of you that are live with us on the Zoom session, there's a number of ways that you can interact with me. You can chat in the chat panel. You can raise your hand if you want to actually have a discussion with me, and I'll unmute you and allow you to speak. Or you can use the Q&A. And now, in order of importance, I'm going to be looking at Q&A first, then I'll be going to the chat, and then lastly going to the raise our hand, probably at the end in the Q&A session. So like I say, please do interact with us. If you're also not connected with us on social media already, I do strongly encourage you to connect with us there. We've got a Facebook group called the Self-Employed Support Network. So if you just Google that on Facebook, will come up. It's a free Facebook group where we help small business entrepreneurs. So I guess you're wondering, if you don't already know, who are we? So we're CPA 4IT. We're a chartered professional accounting firm specializing in service-based businesses. And we've been doing that since my father founded the firm in 1984. So we are a second-generation accounting firm, and we do specialize specifically in service-based businesses. And we've got a lot of experience doing that. And I'm very proud to say that we've got a really experienced team where we've got team members who have been with us for over 20 years. So that's really exciting about our organization. We're also not only blessed with a great team, we're also blessed with great technology. And I'm a really big advocate for technology. One of the little known facts about myself is, prior to becoming an accountant, I was actually a software developer. So technology is a passion of mine. And it's something that we have ingrained into the core of our culture. As a result, we've been able to be recognized as one of the top 50 cloud accountants in North America for the past 5 years. We're also a QuickBooks Elite Pro Advisor, which is the highest tier that you can reach. We do also work with Xero if you're on that front. But the best pricing we can get for you is really around the QuickBooks, and we've got some amazing discounts. So if you're thinking of leveraging one of those great tools, let us know. We've got webinars, we've got great discounts, all sorts of amazing stuff. And then another little fact is that we are an ISO 9001 registered firm. For those of you who aren't familiar with ISO, that basically means we have a system of procedures and processes that we go to make sure that we do a really great job with your file. And that process is audited externally to make sure that we are following that process, and we are also constantly striving for improvement to make that process better. Because that's one of the big things about being a cloud accountant. We want to be future focused. We're always striving to do better. We know we can do better, and we're always to look for ways to improve our service and deliver a better experience to our customers. Hold on one second. Sorry about that, everybody. The joys of working from home. This is COVID for you. So today's session, I really want to answer 3 key questions. What is a personal real estate corporation, or a PREC? And I'll try to be brief on that, because I know many of you have already been through some of this. Is a PREC right for you? This is a really key question, because, in some of the discussions I've been having, I've been identifying realtors who didn't think a PREC was right for them, but after a few questions and answers, we were able to find out there would be a tremendous benefit for them from setting up a personal real estate corporation. And then, where the rubber hits the road, we're going to talk about the top 10 tax benefits of PREC. So I hope this session will be useful. I do want to encourage you guys to connect with me and share your questions in the Q&A. And in fact, we've already got our first Q&A here. Will the webinar be recorded? Yes, the webinar will be recorded. As I mentioned earlier, it's also streaming live on Facebook right now. So you can go back into our Facebook channel and watch this at any time. It'll be posted to our YouTube channel as well. So first question done and out of the way. Please do keep those questions coming as we go through this. So what is a personal real estate corporation, or a PREC? I'm going to fly through this really quickly. If you guys have more questions, let me know. It's a separate legal entity. It is separate from you. It owns the real estate business that you work for, and then you work for the PREC. So basically what this is, a separate legal entity that you are going to create with an article of incorporation. This is going to allow you to take advantage of all the tax benefits that we're going to talk about today. The only downside to a PREC is that it is a separate legal entity registered with the CRA. So once you create it, you have a separate legal obligation to file tax returns for that entity. So on the personal tax return, you've always filed what's called the T1, and you're effectively filing as what we call a sole proprietor. If you take advantage of this opportunity, you're now incorporating a separate legal entity that will have its own filing obligations and deadlines. So the only real downside, like I said, is the cost of maintaining that new corporation or that new entity. And of course, making sure you file your taxes on time, because The worst thing you can do is, file your taxes late and pay interest and penalties to the government unnecessarily. So the first and foremost question that everyone wants to really know is a PREC or personal real estate corporation right for you? And obviously the best way to answer that is to sit down with a professional, go through your individual circumstances and figure out whether this is a good fit for you. Now, some of the tools that we've developed over the years to try and help people figure out whether incorporation is right for them, we've got things like guides on the benefits of incorporation, all sorts of stuff. But the thing that I thought would be most useful to you guys is our calculator, which helps you to calculate the financial benefits of incorporating. So it shows you the financial benefits of a corporation versus a sole proprietor. Now, it's a really high level, but you'll be able to quickly see, okay, if I incorporate in this individual situation versus if I was a sole proprietor, what are the different taxes that I'm going to pay? And it calculates CPP and, all those relevant taxes, payroll deductions, all that fun stuff. And it's done in a really simple way. I think that's a great tool for you. Once you do figure out if incorporation works for you by figuring out, is there a financial benefit? Because quite frankly, if there's no financial benefit, you've got an additional cost that probably isn't the right solution for you. And I know there's a couple of questions that are floating around online. We even have them on our website, like, are you earning more than what you need to meet your daily living expenses? This comes back to that question of, are you able to leave money inside your corporation and take advantage of the small business tax rate? We'll talk about that. Do you want to save money for retirement? There's a bunch of really nebulous questions out there, but this calculator is going to help you figure out what's the bottom line financial benefit at its really lowest, most basic level, because we're going to be talking to you today about some more advanced tax strategies that can have even greater rewards that go well beyond what our basic calculator can help you figure out. But first step, probably have a look at that calculator and see if there is a financial benefit for your situation as it stands today. If it doesn't show a benefit, or if you have more questions, book a free consultation with us and we'll walk you through whether it makes sense in your individual situation. Now, if you do choose to incorporate, we do offer incorporation services. We're really low cost. It's our milk or our loss leader in our business. It's our opportunity to demonstrate to you the value that we can deliver as professionals. So we've got some really amazing pricing that's on our website. And also exclusive for you guys who are listening to this presentation, we've got a discount code for you. It's capital P, capital R, capital E, capital C, number 2, number 0. So that's PREC 20. That'll get you 20% off any of the pricing that's on our website right now. So if you're ready to go, log on to our website, choose a package that fits you, enter that coupon code, and we'll get you incorporated within 24 hours. Now let's get on to the benefits. Really, what are you going to be able to what are the real advantages of setting up this corporation? Because as I said earlier, there's a lot of confusion as to whether these PRECs are going to be an advantage for individual realtors. I was dealing with one realtor the other day and looking through his financial situation, and he didn't think that PREC was going to be a fit for him. But when I looked at the last couple of years of T1s that we had 1 year where it was a loss of a small loss, and then another year where it was a gain of $200,000. And there would have been about a $12,000 benefit for us being able to play our accountant's shell game and maximize the financial benefits through the use of a corporation. So how do we do that? We do that through a number of tools, and I'm going to walk you through about 10 of them today. There's more than we could possibly go through in the short amount of time that we have, but I'm going to give you our top 10. So first and foremost, there's the low corporate tax rate. For Canadian-controlled private corporations that are taking advantage of the small business deduction here in Ontario, that tax rate is only 12.2%. Now, compare that to the personal tax rate of 53.53%. There's obviously a really significant advantage of being able to have money taxed at the small business corporate tax rate as opposed to your personal tax rate. Now, the reason I've got a picture of a safe up here is because really the way we take advantage of that is we need to actually have a place to save money. Because if you're not leaving money or retaining money inside of your corporation, you're not going to be able to take advantage of this small business deduction in a meaningful way. Now, there are some other things that you can do within a corporation that are still going to help you. Obviously, first and foremost, maximize those deductions, because every dollar that you are able to deduct as a business expense is a dollar you'll pay zero tax on, right? So we want to do everything we can to minimize the total tax. And so if we can maximize those deductions, that's the first step. But of course, you could do that in a sole proprietorship as well as an incorporation. So it's not really a benefit of a personal real estate corporation. There are some other things that can be done. Again, usually not really in the realm of but they are, I'm clicking the wrong way, drive myself nuts. But they are out there, so we'll just mention them. So the other thing that you can do is there are tax credits that you can take advantage of. You know, most people have probably heard of the SR&ED tax credit. There's farming tax credits, there's daycare tax credits, there's trade tax credits. There's a couple of different tax credits out there. Most of them aren't really going to fall in the realm of realtors. Maybe something with the SR&ED. So again, if you want to have a discussion with one of our professionals, we can let you know if there's something specific to your situation that might be over and above the low corporate tax rate. Now, the low corporate tax rate, this is sort of related to tax deferral. So what happens when you retain money inside your corporation is you're going to pay corporate tax on that. And the goal here is we're going to use your corporation as sort of a personal savings plan. So we're going to defer tax by not taking it into your personal salary now, by retaining it in the corporation, paying the small business tax rate, and waiting until retirement to start drawing this money out. Usually in retirement, it's going to come out in the form of dividends. And let me just say that dividend versus salary question, that's a whole nother question. Once you're incorporated, we've got whole webinars dedicated to understanding, bookkeeping, tax, dividend versus salary, source deductions, all this fun stuff. So we're going to leave that question for now, but the goal is really put money inside this corporation as a savings vehicle. This allows that money to be invested at a lower taxed rate. So you're been taxed at only 12.2% versus 53.53%. So you've got a lot more money to invest. And because the way compound interest works, if you start with a bigger number, that grows substantially faster than starting with a small number. So paying tax at the end, as opposed to upfront, is a huge, huge, huge advantage. We often refer to that as the time value of money. So first of all, you're saving on interest, you're saving on the cost of potentially borrowing to invest, and then you're able to compound the growth or the return on money you invest. And this is a huge, huge, huge advantage. And people don't really realize until you put down in a spreadsheet and start showing how money compounds over time and what an impact, being able to start with a bigger number can have when it comes to your overall financial success, right? And that's what we're trying to do here at CPA4IT. We want to help you increase your personal net worth and decrease your stress when it comes to accounting and finance. So another big advantage that people are talking about is this concept of income splitting. So income splitting is a great, great advantage. I mean, there's some ability to do this within a sole proprietorship. When we talk around salaries, with a corporation, we add another layer, which is the ability to income split through the use of dividends. Again, I said we'll talk about the details of dividend versus salary in another session. But what is important to know and understand about dividends is there were some new rules put in by the Liberals, Gen 1 2019, that did really curtail. We used to have even greater, really substantial benefits around income splitting, or what the Liberals called income sprinkling, that have been eroded. There are still advantages but you need to understand what the implications of TOSI are, which is tax on split income. Effectively, what the government has done is made it tax ineffective to give dividends to children under 25 and spouses that aren't actively, or family members that aren't actively involved in the business. It's not that you can't give them dividends, you can, but effectively the dividends are going to be taxed at the highest personal tax rate unless they are exempt from TOSI. And there are a few exemptions. One of the biggest ones is once you hit 65, you can income split with your spouse or your partner through the use of dividends. Now, of course, if your spouse or partner is actively involved, or any adult, what we call non-arm's length person is working in the business more than 20 hours a week, then we can do dividends to them still. In addition, if they are if they are over 25, then what we can also look at is a reasonableness test. Now, salaries have always been subject to a reasonableness test. I personally am still a little leery around using the reasonableness test for dividends, simply because we have no case law yet, right? It's relatively new. We haven't seen audits yet on reasonableness for dividends for non-arm's length people who have been working in the business less than 20 hours a week. Generally speaking, I guess the bottom line is there's still advantages to using dividends inside of a corporation, but before you declare any dividends to anyone, you really do need to speak with your accountant or financial professional to make sure it's being done in a way that's going to really work tax effectively for you. Because the worst case scenario is this becomes subject to TOSI and you've received really no financial benefit in declaring dividends to a family member. So again, great benefit that we do have with the personal real estate corporations here in Ontario is that they did basically enable you to set up shares for family members. You have to be the common shareholder. The realtor has to be the common shareholder, but we can do preferred shares for different family members. And we are, if we're doing that incorporation for you, we're going to recommend doing that. Not only for the ability to do income splitting with the spouse once you hit 65, but also you never know when rules change. Tax rules change all the time. You know, we could end up in a situation where, you know, we end up being able to dividend income split again sometime down the road. But, you know, it is still very much a tax advantage and something to be taken advantage of. Now, income smoothing is, in my opinion, one of the largest benefits to realtors. And it's not something that you're probably going to see discussed anywhere. And I had to sort of Google a definition for this presentation because we always have notes that go along with this. And so anyone who wants a copy of the PowerPoint deck, every slide will have some additional notes beyond, of course, what I'm sharing with you today. So they say basically income smoothing is an umbrella term for the various techniques and methods used by accountants and financial experts for controlling or hedging the effects of high rises and sharp falls in corporate income. As is commonly used, income smoothing is often associated with clever manipulations of income or profit, creative accounting techniques, and the application of general accepted accounting principles. However, real practice income smoothing goes beyond these. It encompasses all strategies used in hedging and against high expenditures or costs and increasing business earnings. Oh, this is a mouthful, right? What does it basically mean? So there's two types of income smoothing. We can smooth income for the corporation, and we can smooth income for the owner managers or the employees that we're remunerating out of the corporation. So really the big benefit is out of the income smoothing to the individual realtor. And by this, what I'm talking about is the personal salary that you're going to receive from your personal real estate corporation, whether that is a dividend or a salary. What happens in Canada is we have a marginal tax system. So we have different tiers, right? And the tax in the different tiers is taxed at different amounts. And as you go up those tiers, the amount gets higher and higher and higher, all the way up to 53.53%. So as a result of that marginal tax system, if we were to have, let's say, 2 years of $60,000 of income versus 1 year of 20,000 and 1 year of 100,000, the combination of those 2 years of 20 and 100 is going to pay more tax because of the peaks and valleys than the 2 years of 60. So if we can smooth income and make it more equal and avoid these peaks and valleys that happen, quite frankly, with realtors. I mean, obviously, sometimes commissions can be large. We're selling our office building right now in downtown Toronto. It's listed at $5.5 million. So you can imagine the commission on that. That's going to make a nice little chunk of change for someone. But those sometimes, that has been on the market for a little while. It's probably going to be on the market for a little while longer. Those deals don't close overnight, right? So as a result, we end up with these peaks and valleys, and they don't often close on December 31st just so you can get your income in, right? These things are going to be elapsed over long periods of time. But if we have the ability to control when we take our income and how we take that income, that gives us the ability to smooth these peaks and valleys that realtors often go through. And like I said, this one person I was talking to, they didn't think a PREC worked for them, and they were a perfect example of peaks and valleys. So a small loss in 1 year and then a $200,000 gain in the next. That is a perfect example. In that individual situation, there was literally a $12,000 benefit to being able to smooth that income. So there are very, very significant advantages to smoothing income. And it is a perfectly legitimate and reasonable tax strategy. Now, of course, accountants, as many tricks up our sleeve as we may have, there are limitations to what we do. So it all depends on your personal situation. And, I'm sorry you're going to hear that. You're going to hear that caveat repeated over and over and over and over again, because it is just a reality of everyone's situation. I can talk to you all day long about high-level tax strategies and tax maneuvers, but when we start getting into applying these, we got to look at your individual situation and make sure it actually does make sense. So a couple of other things that are really, really great perks of PREC. Perks of a PREC, I love that, are home loans and auto loans. So the Income Tax Act does allow for corporations to enter into valid loans with employees for the purpose of purchasing a home or an auto. Now, this is what we call an employee loan. There are also shareholder loans, which are a whole nother thing. The big advantage that you've got here is this allows you to take a big chunk of change out of your corporation without having to take that into income and have, all those nasty effects that we talked about earlier with the personal tax situation. So if you want to put a down payment on a house or a car, you can take that out of your corporation. And effectively, this allows us to smooth, again, that large withdrawal over a longer period of time. And typically you can do that with whatever you might find comparable in the market. So for example, home, it might be 20, 25 years. For a car, it might be 5, might be 7 years, anything comparable. Now there's an entire process that goes around how we document this and what needs to happen to make sure that it's not deemed to be a shareholder loan. Because if it is deemed to be a shareholder loan, which there are some pros and cons of that, but that didn't make our top 10 list, you will have some negative implications. So again, if this is something you're considering doing, what we always say is talk to your accountant before you go through any of these big life decisions to make sure that we can optimize how these life decisions happen. But big advantages of this tax benefit as well. Now, insurance strategies. There are so many insurance strategies. I'm really going to talk about one strategy because this is a really, really exciting strategy that is available right now. We refer to it as the ICE maneuver. It's sometimes referred to as a leveraged life insurance strategy. It's also sometimes called I think they call it the 10-8 or the 9-7, something along those lines. Effectively, what this is allowing you to do is get out a bunch of money out of your corporation tax-free today. And it's not completely free. There are charges and costs that go along with this tax maneuver. But if you're a high net worth individual and you're looking to get access to equity that you've built up or retain earnings that you built up inside of your corporation to do something with, maybe, it's to pay for your kid's wedding, maybe it's to, do a big renovation on the home, lots of reasons you might want to get access to that capital right now. And normally, if you were to do that, you'd probably have to take that out in the form of a salary or a dividend. And this strategy allows you to do it very, very tax effectively. Now I'll give you the high level. Again, I'm not an insurance agent. I'm not an expert on these strategies, but I've worked through them with a number of our clients. And so I certainly understand the high level concept and the tax issues behind it. So effectively what happens in a leveraged life insurance play is a bank will lend you money based on the life insurance as collateral. And what happens is they lend this money to you personally. You personally deposit that money into the corporation, which is a loan from you to the corporation. And the corporation owes you that money back. With that money, you purchase a life insurance policy. Now that you've purchased that life insurance policy, that's the asset that the bank is lending you money against. That life insurance policy will continue to grow and increase in value over time. And the beneficiary, when they receive the payout for that life insurance policy, it gets paid out through something called a capital dividend account. And the beautiful thing about this capital dividend account is it's money you get out of your corporation 100% tax-free. So insurance, they have a lot of great tax benefits, primarily the fact that the benefit is tax-free. So when you receive a benefit, you take that out of your money out of your corporation tax-free and pay off this loan. So now I think we understand this concept of the bank has lent you money, you've purchased an asset, and you understand how you're paying back that bank. And the bank is continuing to accrue. That loan's getting bigger and bigger over time because it's covering off your interest payments and all that. You're not paying any money out of pocket. So the bank gives you money, you put that inside your corporation. That money grows. In theory, it's hopefully growing faster than the cost of the interest. And there are actuaries who will figure out basically all in your lifespan and, the rates of return where those deltas will be over time. And that might give you a small benefit of, where the real estate or the insurance program has grown faster than your cost of borrowing, but that's going to be marginal. Where the real benefit comes out of what we talked about earlier, where you deposited that money and created that loan. So because you deposited that money and created a loan from you to the corporation owes you that money back, and you can take it out anytime you want, tax-free. So basically, this is giving you a huge ability to take a bunch of money out of your corporation tax-free right now. Now, the entire cost, in theory, is going to be borne by the growth of the return on this investment that you have. Now, are there some risks associated with it? Yes, because the risk or the return of the growth of that investment could end up being lower than your cost of interest. And that might end up being some cost. And of course, there's costs from, the insurance provider and all that all the way along. But I can tell you that even if those costs end up negative, which, in a lot of these situations they aren't, you're still getting a massive, massive, massive tax benefit by being able to get that money out without having to take it into a salary. And that's potentially a 53.53% benefit right now, which is huge and really exciting. But again, there's other strategies that are available. Another one are IPPs or PPPs. So what are these? These are types of pension plans. So an IPP is an individual pension plan, and it's basically a defined benefit plan governed by a whole bunch of provincial legislation. Typically, these are really, again, for high net worth individuals. There's lots of strategies that you can make use of before an IPP really starts to have a financial advantage for you. The reason that those are sort of reserved for high net worth individuals is IPPs bear with them traditionally a fairly high cost to be able to manage and coordinate these because it's literally a pension for an individual or a person. The difference between an IPP, an individual pension plan, and a PPP is that a PPP allows you to basically move back and forth between defined benefit and defined contribution. This gives you some added advantages, being able to increase the amount you contribute some years, decrease it others. So some even greater benefits than come along with a traditional IPP. But again, if this is something you're considering, I'd be happy to introduce you to a professional that does these. We work with a guy named JP Lozano from Integris, and I believe JP was the guy who actually invented the PPP tax maneuver, which is the ability of moving back and forth between defined benefit and defined contribution. And it does add some, even like I said, some even greater benefits to a program that's already got some great benefits. So again, what are those benefits is probably the question you guys are asking me right now, which first of all, IPPs, like I said, are typically only beneficial to people who are earning probably over $100,000. But what it allows is, first of all, it allows you to make contributions that are typically larger than the RSP contributions. Now, an IPP will take the place of an RRSP, but it's usually going to give you more room than you would have in a traditional RSP. In addition, what this is allowing us to do is to get a creditor-proof investment that is an expense deduction to the corporation. And where this can really start to have huge advantages is when you're starting to creep up close to the limit of the small business deduction. And I think I sort of glossed over this a little bit earlier, and I do see the question that's come up there. I'll come to that in just one second. When you start to creep up to this small business deduction threshold, anything over the small business deduction amount, it's going to pay tax at more than double the small business rate, substantially higher rate. The small business deduction rate is limited to small businesses and caps at $500,000 net income. So if you're earning more than $500,000 net income, anything over that 500,000 is going to be taxed at this rate. Again, sort of similar to the marginal tax system in the personal tax side, but at much larger scales. So the gap obviously is going to be large, but also the increase is going to be quite large. Now there's some strategies that you can use, like maximizing deductions and increasing your salary and increasing RSP contributions. But at some point you're going to hit a limit, and that's where a real benefit of these IPPs and PPPs are going to come in. Is so you can also get a whole bunch of benefits based on years of service. So this will often allow a big lump sum that you can do in some years to be able to do that, as well as be able to deduct all the costs associated with the IPP and managing it. Because as I did say, there are quite usually large costs associated with that, but they are all deductible to the corporation. Now let me jump in here. We've got a question. So this is, so we got a question here that says the premiums are not deductible, right? Unless required for a loan. The insurance is a funny thing, because we've got a whole bunch of different types of insurance. You got health insurance, you've got errors and omission insurance, you've got disability insurance, you've got whole life insurance. So life insurance, the premiums are not deductible, exactly like you said, unless it's specifically required for a loan. Now, one of the things that's important to know and understand is that even if you can't deduct the premiums, setting up the corporation as the beneficiary of a life insurance policy is going to bring some advantages, because first of all, what happens is it gets expensed on the income statement and then added back on the tax return. That's a fancy way of me telling you that you're able to pay for those premiums with money that's been taxed at the corporate tax rate, 12.2%, as opposed to money that's been taxed at your personal tax rate, which could be as high as 53.53%. So setting up the corporation as the beneficiary still has some advantages when we're talking about life insurance. Now, disability is different still. So disability, the way it works is you're allowed to deduct the premiums for a life insurance policy. However, if you choose to deduct the premiums for, disability insurance, if you choose to deduct the premiums for disability insurance, then any benefits you receive become taxable. So for that reason, we traditionally don't recommend deducting disability insurance. Now, one more still is we got things like errors and omissions and health plans and those types of things, health and dental plans. Those are 100% deductible with no real issues. So hopefully that is the answer to the question you were looking for. And now I got to just figure out where I left off on these IPPs. So I think I told you that the contributions are typically greater than RSPs. They are based on your age, employment income, and a whole bunch of actuarial calculations, which can be a big advantage because if you've had a corporation around for a couple of years before you set up an IPP, which is a common scenario because usually like takes time to grow, right? Then you can do a whole bunch of calculations that allow you to do a large lump sum contribution based on years of service. The contributions do reduce or eliminate any allowable RSP contributions to the employee. So typically you're not doing this and RSPs, you're doing a pension plan instead of RSPs. And like I said, RSPs are a great way to sort of kind of do this on an entry level way by contributing to your own RSPs and increasing your salary, and then you get a larger expense to the corporation, but the individual, because they're getting the RSP contribution deduction on their personal tax return, their income is still lower. But you obviously hit limits with how much you can contribute to your RSP based on the salaries that you've been receiving in the past, which also, one other thing is, our goal when we set you up with a corporation is to pay you as little salary as possible, right? Because of this whole marginal tax system that we've talked about. That then means that the RSP room that you get is quite small as well. So you don't get a huge RSP option. So again, another big benefit that this IPP and PPP comes in is the fact that you might be able to will be able to have a larger amount that you're able to contribute. Is there anything else in here? I think that's really it on IPPs. So we'll jump into what is really the second last of the tax tips that I wanted to go through. So capital gains exemption. Now this is interesting because this is one of those things that is being touted online as one of the real big benefits of PREC. And it sounds really sexy because you're getting this lifetime capital gains exemption of $883,384 as of 2020. And that does usually grow with inflation. And now, first of all, let's break this down. So first of all, capital gains, you pay tax on only 50% of a capital gain, which effectively means so the benefit of the capital gains exemption, which is still a real benefit, is really reducing $441,692 of real taxable income. Okay, because on a capital gain of 883, you'd only pay tax on half of that, right? So it's saving you the tax on $441,692 as of 2020. However, there's a bunch of stipulations around this. So first and foremost, this works because you're selling shares of an eligible CCPC. Or eligible shares of a CCPC, Canadian Controlled Private Corporation. I got to watch it with my acronyms. So first and foremost, that means you have to find someone who, one, likes your business, values it at the same level that you want and is willing to buy it from you, and two, is actually willing to buy shares and not assets. Many purchasers, when they're actually doing a purchase of a business or an acquisition, usually want to buy assets, not shares in a company, because when you buy shares in a company, you basically bring on any past, potential legal obligations and other issues that might come along with that corporation. So in most situations, there's an incentive for the person selling to sell shares because they get this advantage of this capital gains exemption, but there's an incentive for the purchaser to buy assets from a whole legal protection and risk minimization strategy. So you really have to find someone who's willing to buy your shares first and foremost, and then there are a whole bunch of regulations around it. So first of all, you're not going to get a capital gains exemption on non-arm's length. So if you're selling to a family member, like my father selling his practice to me, is not going to be eligible for the lifetime capital gains exemption. Trust me, that was really frustrating for me, and it seems unfair, but it is just the way it is. Sometimes, some of the things that happens with CRA and taxes are truly unfair, and sometimes there's some great advantages, like the personal real estate corporation, where you've got a tremendous opportunity to take advantage of it, so you should. There are a couple of other things you should be aware of, and that's really around the ownership of the shares. You have to, if the corporation's been around for if the shares have been around for more than 2 years, they must not have been owned by someone else in that last 2 years. Now they can be less than 2 years old and still be eligible. So you can sell a corporation that's less than 2 years old if you can find someone interested in buying it and get that capital gains exemption. I want to meet the person who's able to take a business, build it up in 2 years, and get that lifetime capital gains full exemption of $883,000, because that's an impressive individual if you're able to do that. And there's a whole bunch of complex stuff. I mean, I could read you through all of this, but I want to leave some time for Q&A, and I've got one more session. So I'm going to, like I said, if you want a copy of the slide deck's got, another like 5 minutes of me reading through really boring tax stuff that I'm not going to go through. So I'm just going to tell you that, this is still an advantage, and it can be a quite large advantage. But there's a whole bunch of ifs and buts and maybes involved into whether you're actually going to really reap the rewards of this capital gains exemption. Whereas, one of the things not really being talked about is that income smoothing, which I think is going to be the largest benefit to realtors. And we do have one more question before I go on to our holding questions. If I closed a deal in 2020, but don't incorporate, no, it would not be part of your incorporation. And this is why you really want to get your incorporations going like ASAP, because there's a whole bunch of specific rules around inventory and work in process, and realization of revenue. So first of all, you're going to have to incorporate. You're going to have to register your new corporation with your brokerage. So first of all, any deals that close prior to the incorporation are probably not going to be, in most situations, 99.9% of situations are not going to be income to the incorporation. In addition, there's supposed to be a whole bunch of allocations done based off of how long you had the listing for, how much work was done on that listing, like if it were done as under your sole proprietorship. That's kind of like, that's going to become really, really hairy, fun accounting stuff, let me tell you, because, how you do that allocation is going to be really kind of loosey-goosey, which is a technical term, let me tell you, to say the least. So, really important if you guys do think that there's going to be a big advantage to taking advantage of the small business rate, income smoothing, all these great things. Get those corporations set up as soon as possible, and get them registered with your broker ASAP, or your brokerage, as soon as possible. So those are really important facts. So holding companies, what exactly is a holding company? Why would you use one? What are the benefits? What are the disadvantages? So let me start with the disadvantages, because again, they're small and they're similar to the disadvantages of a PREC. You've got costs of setting it up and maintaining it. That's your real disadvantage, right? So you're basically, doubling your accounting fees and services associated with that. But there are some big advantages to a holding company. There's some limited liability because we're able to move money out of an operating company into a holding company. So the risks of the operating company are sheltered from the assets of the holding company. That's usually one of the big advantages that you get, but it's a non-financial advantage. So really, the reason you're going to set up a holding company is once you start to receive some actual financial benefits that exceed your non-financial benefits. First and foremost, what you're allowed to do is move money from your operating company to your holding company tax-free through the use of dividends. So you can get these tax-free dividends that you're moving up and moving out of your operating company into your holding company. That's where we get that sort of asset protection. And this is important from the lifetime capital gains exemption, because remember I said there's a whole bunch of if, buts, maybes. Is one of the requirements, another requirement of the lifetime capital gains exemption is that 90% of the revenue has to come from operating business. So if you've got a whole bunch of investments mixed in with your operations, that could potentially void your capital gains exemption. So moving out and sheltering those investments into another company and having a holding company that does your investments and an operating company that does your operations will ensure that you can keep that lifetime capital gains exemption. So that's a financial benefit there. The other financial benefit that you're going to get is, as I mentioned earlier, the tax rate on non-operating income is higher than it is for the small business deduction limit. So if you have what we call passive or investment income, that's taxed at a much higher rate than your operating income. And when that's all intermingled into one company, you've got a little bit of room being able to deduct the management fees against that investment income. But things like deducting your salary against that is not going to work unless you've wiped out all of your operating income. So what CRA basically says is, if you want to apply other expenses that aren't directly related to the investments against that investment income, then you have to first have wiped out all of the operating income with those expenses. Then and only then will it be applied against the higher taxed income. But when we separate out the two, and we've got a holding company over here and an operating company over here, what that allows us to do is we would, of course, have your normal expenses related to the management fees, and if it's an investment property, all the costs that go along with that. But in addition, you can draw a salary from this corporation, potentially wiping that investment income down to zero. And so you're not paying any tax at the high rate. Now, because you've taken your salary over here and you're not taking it over here, that basically means this operating company has more income because it doesn't have an expense, your salary, that's reducing the taxable income. So it's got more income and it's paying, it's going to have more tax, but it's more tax at a lower rate. So it becomes tax effective. And generally speaking, once you have probably about $100,000 to $200,000 of investable assets, this is where a holding company is really going to start to reap some financial benefits. So again, if you're building up money inside of PREC and it's starting to grow, you want to reach out, connect with your account manager or your accountant, your financial professional, and say, hey, does it make sense for me to have a holding company? Is this something we should start talking about now? And again, you want to get those wheels rolling and those planning going, because depending upon how it's done, we might want to do some complex tax planning and tax structuring where we'll bring in other financial professionals like tax lawyers and stuff like that. So, there are different areas where we bring in other accountants who have expertise in different areas. And, when it comes to hiring an accountant, it's very much like hiring a doctor. You want to find someone who's an expert in what you're doing. So you don't go to a foot doctor when you're having chest pains, right? You want to go to a specialist. So like for these precs, we're specialists in this. We've been doing service-based businesses for decades. We know all the tax maneuvers. We know all the tax strategies. But when it comes to corporate restructures and some other things, we'll bring in tax lawyers, and we have teams of tax lawyers. We'll also bring in, insurance agents and, specialists in IPPs and, all the different team of advisors that we need, people who specialize in shred. We've, spent, over 30 years building up a team of resources designed to assist people just like you and make sure that you're getting the fullest and greatest advantages of what I think is a really, really tremendous opportunity for realtors. So if you are on the fence and you still don't know whether it makes sense to set up and incorporate a personal real estate corporation, I do encourage you to book a free consultation with myself or one of my team members. You can go online to our website. We've got a Calendly link, which is really easy. You can find a time that works for your schedule and book it just like that. Get a time to come in, which right now come in is through Zoom. We're doing this all virtually because of COVID. Down the road, it might be in person again, maybe. And of course, if you are ready to go, you can go straight to our website. And as I said earlier, we've got a special discount code for you guys, which is capital P, capital R, capital E, capital C, 20. That's PREC20. And that'll get you 20% off any of our incorporation packages. You can go in there right now, fill in the form, and within 24 hours, we'll be able to get you incorporated. So with that, I know we've done a little bit of Q&A as we've gone, but I've got about 7 minutes left for any of you who've got any additional questions. So I'm happy to take those and field those now. So please do share those. Otherwise, thank you guys very much for taking the time out of your busy schedule to join me today. I'd love to hear your feedback. Was this helpful? Did this answer any questions? Do you have more questions? Are there things that we can add into this session? And we are going to be doing these recurring, and because as we get the word out, so let us know. I guess it looks like maybe we answered most of your questions as we went. Either that or I didn't do a very good job. So I hope you guys found this useful. We have something coming through. What are PREC's maintenance fees? So there are no sort of maintenance fees, so to speak. The maintenance fees, I guess, are your cost of your corporate tax filing obligations. So that's really it. When you do an Ontario registration, it's different than a federal registration. You don't need to re-register every month. So if you're doing a federal incorporation, which is not applicable for Ontario PRECs, you would have an ongoing cost of re-registering that. But there are no maintenance fees over and above your regular professional fees that you're going to be paying into your professional governing bodies. But beyond that, there's no actual maintenance fee for a PREC. But your ongoing accounting fees, that is really where your cost is going to come in. And, that depends on, what level of service we're providing for you. Are we doing bookkeeping? Are we just doing a tax return? Do you have any other complex issues? Do you have investments? Do you have a holding company? The price can range quite extraordinarily, depending upon your situation. So what I would recommend is, if you're wondering about what those fees might be, come in, book an initial consultation, and we'll be happy to give you an individual quote for your situation and tell you what we think those prices might be and how we might be able to increase your net worth and reduce your stress. So on that note, I think we've covered all the Q&A. Again, thank you guys for joining me. I'm going to give you guys 5 minutes back or 4 minutes back on your schedule. Maybe grab another snack before your next meeting or what have you. Thanks again. And please, if you've got realtor friends that you think might benefit from this, please do share it with them. It would be appreciated. Excellent. Glad to hear it was helpful. Bye for now, everybody. See you soon.